In today's weekend recap, we are going to be discussing why you may not want to be buying the S&P 500 and the triple Qs at this moment in time. Because if you do, you may just be falling into a trap and you may be caught by just catching a falling knife. The market is weak, and we're going to be discussing the different price levels that are happening in the market at this moment in time, so that way you can be better prepared for the next trading session. So if you haven't already, please go ahead and leave a like down below. Please go ahead and subscribe to the channel, that way you do not miss any of our videos whenever they are released. So if you know anybody that would find this video useful, please go ahead and share this video. We would greatly appreciate it. Without further ado, let's get right into it. Welcome to the Options Trader Lounge, where we talk about generating income and growing your wealth within the US stock market using options. Thank you all for tuning in. Get yourself a drink, sit back and relax. Let's get into it. So if you like my Jim Cramer sound button, please go ahead and leave a comment down below. For you Jim Cramer fans, it would be nice to see what you guys think about the trading man on CNBC. Anyways, let's get right into it. Yeah, so the market is weak. We are seeing many different sell signals at this moment in time. We are not at this moment in time seeing any buy signals. So there's no reason for me to be very bullish to anticipate a bounce in the market. Looking at the triple Qs, we have seen the market close down big just by looking at this the open, close, high, low on the weekly candle. We currently see that the triple Qs is down negative 1.8%. Looking at the S&P 500, we are getting another down week with not so much of a reason for a buyer to really be interested at these levels, with the market closing down negative 0.29%. Now that may not seem so big on the S&P 500 for a sell-off. However, you have to keep in mind that the market does not go down in a straight line. There are moments and times whenever we are in a sell-off that it does take a pause before it resumes lower. Now we are currently looking at the weekly candles on the market. What I have here, and you can closely see that it's very much resembling the price actions that we are seeing on the triple Qs. On the S&P 500, we are seeing weakness on the momentum indicator, which is the MACD that I always keep here on my weekly candle whenever I do my analysis to determine the momentum in the overall underlying instrument. So looking at the S&P 500, we are seeing a dip in the blue line here, which is a faster moving average, right? And so this is actually on a decline, which suggests that momentum is slowing down. Once we get this crossover, then it's all reins to the bears to take over the market. So we haven't gotten that crossover just yet, but if we do, there's going to be a big momentum shift, and I mean we're already seeing that at this moment in time. Looking at the triple Qs, this is much more significant. As we know, the tech market has been on fire this year. Year to date, I want to say, let's see, looking at January, if we were taking this candle here, this should be the beginning of the year, to where we are now, actually at the highs, that was nearly a 46% increase. We are now back down to a 36% increase year to date on the market. So that is pretty significant as far as how fast this market is moving for the tech sector. Now, whenever a market explodes this rapidly, there has to be some sort of pullback to the mean. And as we can see, that looking at the MACD, we are seeing a crossover that should take place this week. We can see this crossover take place this week. And if we see that, we can definitely assume that the market is going to pull back into this this weekly exponential moving average, which is the 15, right? So if we see this crossover, and if the market does sell off further into next week, we should see this test of this weekly moving average. And once we do hit it, then we are going to reevaluate at that moment in time to look at different levels of where we may see a level of support where the market could sort of consolidate or even bounce off of. And so the way we determine that is by really just looking at it day to day, seeing how each day closes. As you can see, if we zoom in to the daily candles, looking at the 3-month chart, we are currently at the 50 exponential moving average on the triple Qs. So that is huge uh, for the market to really pull back to this level, because when you move to this level, you're definitely finding a lot of buyers who may want to step in, but at this moment in time, it's very much of a indecisive candle that formed on Friday's close, which is what we have here, right? This is a doji candle where you see a body right in the middle of the week or of the day's price action, and then you have an upper wick and a lower wick. So this is a doji, which pretty much represents indecision in the market, and we can take that as a positive sign that no one knows where the market wants to go at this moment in time. We are definitely going to have to wait and see how Monday's price action closes. If we close down below, we are looking at different levels of support, right? The major one is going to be down here, where you see a lot of price action kind of uh, former resistance, now support, then it kind of tested here as support, broke down, and then recovered and reclaimed as support. And we are most likely going to see price trade around this level. Now, if we see a complete collapse in the triple Qs, we are going to be looking down below on the weekly candles, where we can see a more of a attractive buying opportunity at the 350 level. 350 is going to be huge for the triple Qs because, for one, it's a round number, and a lot of traders seem to gravitate around round numbers, where we could also see a bounce off support back here in October of 2021. Now, what I want to point out today, which kind of explains why we see this big sell-off in the week of this past week's price action, um, we see this big sell-off because we had the big report on CPI. So looking at CPI's report that took place on August 10, we saw um, an increase from the previous reading of 0.2%. So the previous reading was a 3%, and now we have a 0.2%. If we look at the actual chart, you can see that for the year, for 1 year's data, CPI, meaning the Consumer Price Index, which measures inflation, has been dipping down continuously month after month. Now, the low was back here, which was in July, which read 3%. And then what we have here on August 10 was 3.2%. Now, this is an increase, and this was very much predictable that we could have easily read, and hence the reason why I remain short. What I was looking at for this week's or for last week's price action to determine my trades to remain short in the market was because I was also monitoring the oil market. Now, as we can see, if we zoom this chart out on the 3-year weekly candle, we can see that oil, as we know, has been continuously selling off, moving lower and lower after the release of the strategic petroleum reserve that the president, Joe Biden, or as we know, Damon Shaw, Dementia, has been really trying to tame the market as far as oil prices goes. And we got that positive result in the sense that oil has been moving lower. However, as we approached the summer season, we saw that oil started to tick up. And because we saw this move up for the past several weeks, I had the hunch that eventually inflation is going to tick back up. Now, because we had this reading back here of a tick up in CPI, that spoils in a lot of different new price levels in the market because now we have to factor in, is the Fed going to increase interest rate once again? Now, as we know, the next Fed interest rate meeting is going to take place in September. And so everyone should be very prepared for September 20th, right? September 20th is when we should see another Fed interest rate decision. And at this moment in time, with this tick up in CPI, it more than likely is going to be that the Fed will increase interest rates once again, which would mean bad for the market, right? Because the higher the interest rate goes, it just means that spending is going to be less, right? The whole idea of increasing interest rate is to tame down inflation and also dampen down demand, right? So we are seeing that right across the board off of the housing market, where housing sales has definitely slowed down. Nobody wants to start buying houses at this moment in time. And in fact, housing prices are ticking down based off of the Fed interest rates because no one wants to be locked in for a 30-year mortgage with nearly a 7% interest rate when we had seen pretty much near zero interest rates the past 2 years. So, with this data in mind, we have to assume that the markets and big hedge fund managers are actually positioning themselves ahead of the Fed interest rate decision, which would mean that this 350 level on the triple Qs would be very attractive in terms of getting us down to that point, because at these levels, these are really extraordinary returns on the market. And hedge fund managers really just want to lock in those prices because ultimately we saw good earnings report, but it may not be the same results in the next few quarters as interest rates continue to go up and CPI may continue to go up as well. But that also means that it's dampening down on demand, which also affects the sales demand for these big companies because it may just weaken revenue. So we have to be prepared for those moments in times. And remember, as Warren Buffett says, when there's blood in the streets, that is when it's time to buy. Right now, we do not see blood in the streets, but with different indicators that are pointing us for a move downwards, that is what we are going to be prepared for. So if you haven't already, please go ahead and leave a like down below. Please go ahead and subscribe to the channel. That way you can get our future updates whenever they're released. And we will see you on the next one.